Jan Vinarskiy, welcome to Acquiring Minds.
Thanks. Well, excited to be here.
Jan, you are the first Acquiring Minds guest to also be a sponsor that our fund, Minds Capital, invested in. So it's a personal thrill for me to have you here. I am invested via Minds Capital in your deal. It is one that I was very enthusiastic about. There's a lot to learn from your story, Jan, from the evolution of your deal as a search deal to an independent sponsor deal and much more beyond. Let us begin. Jan, first, some background on you, please.
Sure. Yeah. And we'll also, a really fun moment for me because the whole search process for me started off really listening to your podcasts. And there was always this little voice in the back of my mind that was like, oh, if I go down this path, how amazing would it be to be on an episode? So surreal, huge thank you to you and all the guests that appeared beforehand, because it really made a big difference. It just made it feel real, like real people were doing it. It demystified a lot. So I'm just kind of excited to get back to the community a bit. Yeah.
Thank you very much. It's incredibly gratifying to hear that.
Yeah. My backgrounds, my career has been in a couple of different spots. So it started in management consulting. So I started my career in Accenture in the strategy consulting division. Really, pretty typical path out of college. Thought there was only a few things that I could do. I could go into investment banking, I could go into management consulting, I could be a doctor, or I could be a lawyer. And I didn't really want to be a doctor, didn't really want to go to law school. Investment banking hours kind of freaked me out. So management consulting it was. And so I did that for 3 years and got burnt out of the lifestyle. Monday through Thursday travel. I was on the road all the time. I did projects out in Minnesota, Philadelphia, and very quickly the glamour of getting points and status and all that wore off, because I would check into the hotel, and once they started saying welcome home when I was checking back into the same hotel, it was a bit of a moment where I thought, hey, I might need to do something different. So I pivoted into tech. My wife and I, we moved to Denver. We joined a smaller, medium-sized tech company called SendGrid. It was about 200 employees. And I was there as a product manager who was leading the development of professional services. So that was my pivot. I was doing professional services at Accenture, but then I moved in and became a product manager to own the professional services portfolio for SendGrid. So did that for a couple of years and got to experience my first exit as an employee. Twilio bought SendGrid back in, I believe, 2018, 2019, somewhere in that time frame. Mm-hmm. And it was exciting. We went from 250 employees at the time, and we got to experience an exit. Twilio was a fun company to be at. We became a 2,000 person company at that point. Twilio is much bigger at this point. But it also began to reinforce a few things in me. One was I really liked building. I loved my time at SendGrid building a product portfolio, but also like being at small companies. I liked it way better when it was 200 people than when it became a few thousand. So a few years later, I left and I joined a boutique consultancy in Chicago. So my wife and I, we moved back to Chicago, where we are right now. And it was a 25-person consulting shop called Tracy & Company. And there I did a lot of growth and strategy consulting across a lot of different industries, focused a lot on building products towards the end of it, but really enjoyed doing that. I became a managing director there, got to build up that practice, really got us to help scale us up, focus on attracting more talent. And then we also got acquired. So that company got acquired by a private equity-backed accounting firm. And very similar story. At that point, I'd been through a couple of different exits, realized I liked working at smaller companies, and I'd gotten enough confidence at that point in maybe curiosity in my desire to build something of my own. And I had an inflection point at that point about, do I stay in consulting and be a partner now and really sell consulting work and do that for the next 10, 15, 20 years? Or do I, finally scratch that itch and try to do something on my own? And my family, I'm a first generation American. We moved from the former Soviet Union in 1995. Once the Soviet Union fell apart, my dad runs his own food truck business, and so I've always been part of the small business world. And started to listen to, coincidentally, your podcast. Started listening to Cody Sanchez, Buy Then Build. Like my epiphany moment came from reading Buy Then Build and realizing, whoa, this is kind of a different path that I could take. And that's kind of what brought me to my search. Decided I would take a hard pivot, convinced my wife that we should risk all of our money and do that, invest every dime, cash in our 401k, do everything you're not supposed to do. And we went all in. So that's kind of where we are today.
And Jan, when and why buy a business as opposed to start one, just given your exposure to tech?
So I think my skill set is better served at scaling out a concept that's proven and building process. I didn't really have a great idea, and I loved the all the concepts in ETA and Buy Then Build of get a business that's already been proven, it's been around for a long time, but it needs scale, it needs marketing, it needs sales support, it needs professionalization. That felt less risky to me than starting something on my own, and felt a way to accelerate it a little bit too, because we had already we'd gotten accustomed to a lifestyle that you get in consulting. And so going from, that to zero was a little bit too big of a leap at that point.
Great. And so how did your search take shape? What were the criteria? How'd you approach it?
Yeah. So my search changed halfway through it, but it started with a very, very typical kind of searcher criteria where it was going to be anywhere from 750K in SDE to about 1.5 million in SDE. It was going to be SBA backed. We were going to go do an SBA loan. If we needed to, we might have gone into a little bit of pari passu debt, but really was looking for the core criteria. For me and my wife, we didn't want to move outside of Chicago, so it was going to be a geographic search. About an hour outside of Chicago was the criteria that we had. And then we wanted something that was in home services or, light manufacturing, about as complex as I would get. So nothing with, super crazy. And I was still fully employed at the time at my consulting shop, and decided that I was going to go down the path of hiring a buy-side broker. So I know you've had a couple of episodes with folks who've used Calder Capital. That's who I worked with, and I had a really good experience with them. They were essentially my buy-side team throughout. It let me test the waters on seeing what deals were out there, looking for proprietary leads, and then kind of went down that path. Now, eventually, the business that I bought, FloorGuard, was quite a different business, but it took the shape of working with Calder to make that happen.
And how did you decide to stay in your W-2 and hire an outside firm to effectively do the search for you, plus more? I think they helped you beyond just bringing you the deal. They helped you close it. We'll get into that. You'll correct me if I'm wrong. So how did you decide to do that? And as opposed to just quitting and going full-time search, which is a little bit more the typical model?
Yeah, I think it was risk aversion, really. So I had a job that, paid well. It continued to provide. And I didn't want to quit that and not know for sure that there was a business that was lined up for me to go into. And so what I wanted to do is get somebody to help me search for a business to see if there was one out there that would close while still having this as a fallback option. I really saw that as an insurance play. And, the salary that I was getting was going to go to paying down the retainer for Calder, but it still allowed us to maintain our lifestyle. So it was a little bit like an insurance play for me. And then I think was realistic enough that my skill set isn't doing a ton of cold outbound, reaching out to owners to try to figure out, are you interested in selling? I didn't think that I would be able to convey my credentials in a way that made me seem serious. I thought that if I could have a buy-side broker reach out on my behalf, it would feel more serious. It would feel more like, you could close on the deal. I had a team behind me. So it's really those two things. To be totally honest, I didn't know buy-side brokerages existed. So when I started planning for my search, I joined the acquisition lab. So I went through the acquisition lab, was one of the cohorts, learned about the whole process of doing proprietary search and kind of understood what that would be. And then I started to look for SIMs out there that I could see if I could reach out to and try to practice, proprietary outreach as part of the cohort. But when I did that, I ran into Calder Capital. That they were one of the, on the sell side. I liked their SIMs. they were really well organized. And then on their website, randomly, I saw that they also had buy-side services. So I reached out, tried to learn a little bit more about it, and it sounded exactly like what I was looking for. I didn't know that that service existed. Honestly, sounded a little bit too good to be true, because they said that they would do everything from finding the leads to being my buy-side team after we put the LOI in. But I liked the impression that I got working with the team there. And so I decided, hey, worst comes to worst, I spend some money doing this. If it's not the right path, maybe 6 or 9 months, I kind of get the guts to quit my job and do a full-time kind of proprietary search.
And what was your kind of ROI calculation on the spend? Because working with Calder is not cheap. I don't want to misquote their pricing, but I think it's a few grand a month. So you'd be outlaying that without any certainty of close. How did you think about that investment?
Yeah. So it was interesting. So I say I was kind of hedging a little bit on, not leaving my full-time job and having an insurance policy and a fallback. But in my mind, I had already made the decision that I was going to go buy a business. Like, it was going to happen sometime within the next year or two, whether or not I go and, find it myself or work with a buy-side broker. So I had already set aside the money for, what we would invest into it and what that search would look like, and if I had to leave and kind of do a full-time search on my own. So I thought I would give it 6 months, which is the commitment that you sign for Calder. If that was the case, I signed up for their gold package. They've got different tiers. They've got an entry tier, I think a silver tier, and a gold one, where you get 10 guaranteed proprietary leads. And they've raised their prices a little bit since then, but I paid $5,000 a month for the retainer. So a lot. It's definitely a lot when you don't know that you're going to go buy a business. But I was so sure that I wanted to go buy a business that, to me, it was a kind of a forcing mechanism to say, I'm going to spend a lot of money doing this. So I'm serious. Like, if they find a good lead, otherwise I'll have thrown 30 grand away, which nobody wants to do. So it was a forcing mechanism for me. And I really had a really strong impression with the team when I met them. And I'd called their references and heard enough people go down the path of using them for services that something in my gut just said, trust them. It sounded like they were gonna follow through.
Well, and if you think about that lump sum or that 6-month commitment of 30 grand, if you had quit your job to search full time, and it took you 6 months, it would have been a lot more in $30,000 of opportunity cost. So even though it feels like a big outlay of cash, when you compare it to the opportunity cost, it's actually much more cost effective. And you don't have to do the work, and you retain your job in case it doesn't work out. You haven't burned the boats.
Exactly. And that's where, at the end of the day, it would have wasted that money, but doing that gave me a fallback. I would have still had a job. Luckily, my job gave me enough flexibility where I worked from home enough where I could take on the on-site visits and the interviews. But that's exactly what I thought, was at the end of the day, I'm still getting, it's not depleting my cash reserves. I'm just using my income to go fund Calder. And if it works, it works. If it doesn't work, then, I pivot to a different way.
And your point about how you thought working with them would confer credibility on you, buyer, or would just give you kind of more heft than if you were just a lone searcher. I've actually heard that from another Calder client and guest on Acquiring Minds, Will Gano, who's in Chicago there as well, also about a manufacturing business. Just a quick aside, his story, I'm not sure that that's why he worked with Calder, but it ultimately played out that way because they got him into a process. The business that he bought was going through a process with being sold professionally by bankers, and he wouldn't have otherwise had access to that process, but for being associated with Calder. So they got him in, and ultimately he was the winner of the deal. So there's definitely something to be said there for the legitimacy that you get by sort of paying for it by working with a Calder or company. We want to hear about FloorGuard. Is there anything more to say about the search or the process of looking at some deals and that you didn't go with, or should we skip ahead to hearing about FloorGuard itself?
Yeah, I would say the only thing that's notable about my experience working with Calder was it really did speed up my search. So from signing on the retainer with them to closing on the deal with FloorGuard was 5 months from start to finish. So much faster than I anticipated, and there was a lot of luck that was involved in there. So I did look at 5 companies in different levels of seriousness. There was another IOI that we put together, a couple of other on-site visits, one with a CNC shop, one for a kind of a home services automation type of business. But it was fast, and it was, to me, that's why, I do a lot of reference calls when folks think about working with a buy-side broker, and Calder in particular. I can't say that my experience is normal, but it was certainly, it certainly paid off. I mean, we didn't even go through the full 6-month commitment. And I think what's related to FloorGuard, which is ultimately the company that I bought, it was a much bigger company that I don't think I would have been introduced to had I done a proprietary, outreach on my own. It was kind of an interesting curiosity how they came up, and happy to pivot there if it makes sense. But I just thought I'd note that because it was really fast. I mean, they accelerated my search process. You probably would have taken me at least a year, 18 months to go find it on my own.
Yeah, I do. But just before we pivot to that, Jan, the deals were proprietary. So none of these opportunities that they brought you were on the market.
No, not that I could tell. So the 5 that I looked into fairly seriously, they were all in that kind of that area where they were thinking of selling. Some of them had engaged either a lawyer or some advisor, but they weren't a public auction. It wasn't, they weren't looking for multiple bids. So it looked like whatever their process is behind the scenes to vet, are you serious? Are you buying? Are you considering buying? Worked because I was never in a competitive process. And FloorGuard too, they had gotten interest from private equity, but they weren't looking for multiple bids. So it was pretty much kind of what they were saying, that you were kind of going up. And I think that probably decreases the price that you need to pay because you're not competing against private equity.
Great, Jan. Let's pivot to the size of FloorGuard and how it was bigger than you expected and the process was faster. You were going to say.
Yeah. So this always makes me laugh when I remember how this got introduced. So, when I was working with Calder, I gave them the same criteria, $750K to $1.5 million in SDE, Chicago, and that's what they use to find companies. Well, when they talk to companies, not every owner is super open to them about how, what their revenue is, what their margins are. But they usually try to give a range. So what FloorGuard told Calder when they were doing the qualifications were, hey, we're north of $1 million in EBITDA. Well, that's one way of saying it. What they were was really 3.7 million in EBITDA. So they were probably the only owners that I've ever run across or ever heard of that undersold the true profitability of their business. But I didn't find that out actually until after the on-site visit. So that's what they said. We had the whole meeting. We were talking about, where they wanted to go. They didn't want to sell to private equity. So that's what started that conversation because we assumed if they said we're north of $1 million that they were, at most maybe 1.5, maybe pushing 1.6, 1.8. But normally people round up, not the way that they did it. So
and why had they understated it so much?
They were very concerned of competition. So they didn't want other people to know how big FloorGuard was. They didn't want competitors snooping around. They were pretty secretive people. So they were they kept a lot of things very tight to the chest.
Okay.
Yeah.
Great. And so in conversations with them, how soon do you learn what the EBITDA actually is? 4 times or almost 4 times $1 million. I mean, you said 3.7?
Yeah, so pretty quickly after, but it was only after the on-site visit. So the way that it worked was we hopped on a Zoom call. We got to know each other. I got to meet the 2 founders. So it was a husband and wife team. Got to meet them over a Zoom call. Got to meet the general manager, and we hit it off. We seemed to have a good conversation, and they invited me to go visit FloorGuard in person. So between that initial phone call to the on-site visit was, I think, a week and a half or so. So I drove out there. And they gave me a tour of the plant, give me a tour of the facility. We go in, we have lunch, basically spend about a half day together, and that goes really well. And then I'm going out to my car, and I get pulled aside by the general manager because he says, I just wanted to give you a couple of more data points so that you know how to craft the LOI, because at that point it was pretty obvious that I wanted to put one together. I was really excited about what I saw. And then he says, we'll give you some more financials, but roughly speaking, FloorGuard's about $4 million in EBITDA is what we did last year. And I had an oh crap moment where I was like, okay, well, that was nice. I'm glad I fell in love with this company, and now I can go wave goodbye and go find the next one.
The plot thickens.
Yeah. So The general manager.
No, please. You.
I was going to say, so the general manager, Nick, he's actually still in the company. He's our COO right now. Him and I are very close. He was always planning on sticking around throughout the transition. But he kind of put a thought in my head that said, hey, you could raise some money to go do this. And I kind of laughed him off at that point because I was like, I don't know how to raise that much money. I already know that if you're getting into a 4 million EBITDA company, those multiples are going to start to be 5, 6, 7x. Who knows? That's a lot of money to go raise. I don't even know how to do that. I was just going to go get an SBA loan and, maybe tap into some friends and family, but that's different. But he at least planted that thought in my head. And then I kind of left and, started to do a little bit of research to figure out how to make this happen. And that's when I reached out. I don't even think it was reaching out. I think I saw a post from Nicholas James, and I saw him start to post about independent sponsor economics and what makes an independent sponsor different from a self-funded searcher. I didn't even know those words. I didn't know the words independent sponsor. I didn't know what carry was. I didn't come from a private equity background. But when I saw the size of businesses and, I saw some of the things that he was writing out, I reached out to him on LinkedIn and I just said, hey, I'd love to learn a little bit more. It's either that or I somehow got introduced, but talked to Nicholas for 30 minutes. And, I, without exaggeration, I think that was probably the most, impactful kind of life-changing 30 minutes that I had had in that whole search process, because that was the second sort of light bulb moment going off between, finding out that, oh, you can buy a business, that you don't need to start a business, to, oh, you can actually buy a much larger business and you can raise, a lot more capital. You just need to change the way that you think about the deal terms. And Nicholas introduced me to some SBIC funds that ended up actually financing the deal and doing equity co-investments. But that made it feel possible to me, at least gave me a chart of how you would do that, how you would structure the deal and so on. Because I had tried before then to structure it as an SBA deal and unsuccessfully tried to figure out how I could retain, 80, 90% ownership by creating some wild, unrealistic, SBA type of structure that no bank would ever approve. And I was at that point, ready to give up. But he showed me a path there, which is now I know a very common path on independent sponsors, but just one that I just had no idea about.
Well, this is so fun because I've heard now the story of that phone call from both sides. Nicholas also shared with me when you called him and that 30-minute exchange that you two had. Of course, Nicholas James, for those who in the audience who don't know, is one of my partners in Minds Capital, the other GP, Max Lummis being the third. And Nicholas is an independent sponsor himself and has been in that ecosystem for a very long time and has been a guest on Acquiring Minds, where he really breaks down his own evolution from searcher to independent sponsor. So we are going to spend a good amount of time, Jan, on this. This is the point in your story where you pivot from searcher to independent sponsor and what that looked like. Before we do, though, let us hear more about FloorGuard. What does FloorGuard do? What is the business? What is the history, et cetera, please?
Yep. So FloorGuard is composed really of two companies. So there's the main business, the manufacturing business, and FloorGuard manufactures epoxy and polyaspartic coatings for concrete floors. So those are the flake floors, the epoxy floors that you would see in garages, that you would see in factory floors. We manufacture all of that, and we have a couple of different chemistries that we do. We also have another business, which is really the birth of the company, which is an installation business where we install those coatings, again, in garages, factory floors. One of our claims to fame is we actually did the floor in the United Center in Chicago way back when. Yeah. So our founders were one of the first ones to do these coatings. They started 35 years ago. The installation part of the company. Before then, the founder was a carpet cleaner and was frustrated by the lack of money that he could make in carpet cleaning, and so decided, hey, let me try to install these concrete coatings, and then built a very successful installation business. And then at some point got tired of all the, in his words, the crap that you could buy from all the other companies out there. Sherwin-Williams and Home Depot didn't like the coatings that were out there, and so decided, hey, I'm going to make my own coating. I'm going to figure out what goes into it. I'm going to source good quality ingredients, and make it so that it was really user friendly, because The problem with older coatings were that you basically got 5 or 10 minutes to work with them. You would mix the part A's and the part B's together. You'd have 10 minutes. And so if you're imagining a big factory, you have to break it up into a lot of different sections, and you don't have a whole lot of room to make mistakes. And the call to fame for FloorGuard was, we call our product Slow-Go. So it's a slow curing polyaspartic, which is the top coat, and the slow curing set of epoxies. It gives you an hour of working time. So if you can imagine like a breakthrough technologically that happened there, from 5 to 10 minutes of working time to 60 minutes of working time, where you could, instead of having 4 or 5 people on a job site, you could have one person. And that's what our founder did. He had one person go to all the job sites, 2 people max if it was a really big job site. And that's what really made the installation arm successful. Then about 15 years ago, it was a husband and wife team. So the wife at that point said, hey, we have a great product, and a lot of people have asked to buy just our product. So they started to sell the product and distribute the product across the US, and that took off like gangbusters. So, right now, if the revenue and the EBITDA split is 95% manufacturing, product distribution, 5% installation, it really started to take off. It was a unique product. There weren't a lot of slow curing products at the time. There's a bunch more now, but that's the history of the company. So 35 years. It's all manufactured here in the Chicagoland area, and they've grown. A really cool growth story from literally just a carpet cleaner to an installation company to installing some of the biggest floors in the Chicago area to then being a major manufacturer.
Well, it sounds like your seller was quite an entrepreneur. First, because just to become successful at epoxy installation would have been pretty difficult, because that today, I've had an epoxy coating business or 2 on the pod, maybe just the one, and it's a hard business. It's pretty undifferentiated. It's just a classic project based, pretty low skilled. I think there's some skill to it, but not super skilled business. So really hard to scale that. It sounds like he did and got some of the best contracts in Chicago. And then to, by night or whatever, figure out how he was going to manufacture his own product. I assume he's not a chemist by education. And not only do it, but come up with something that's really successful. That is quite an epoxy installation contractor that was able to do all this. So yeah, anything about him that you, as you got to know him, that kind of speaks to this uniqueness?
It's one of the things that I most admired getting to know him and the whole story was just that it was as entrepreneurial as it gets, bootstrapping, starting from nothing, didn't have a whole lot of money coming into the whole thing. So everything was self-financed and self-funded. I think it was just, good old fashioned kind of grit and determination, just wanting to get a really good quality product that was out there, not being satisfied with what he could buy. And then just that thought of it can be done better. And I can, when I kind of got to know, how did you get these formulas? What was your secret? It was self-taught. It was, a lot of calling different chemical vendors out there and asking them, what would you do in this situation? How would you formulate these compounds together? A lot of, down the road, then it was, the university from YouTube, right? Going through and looking at how are people formulating different things. He had his own, very natural R&D arm, which was his own installation business. He could test all of his, formulations out there and feel pretty validated about it. So it is pretty inspiring. It's one of those really cool stories where you start from, really just this tiny little company. And the other thing I'll note is epoxy flooring has gotten a lot more popular in the residential space in the last 10 to 15 years. But he started doing this about 30, 35 years ago, well ahead of the curve, really only when it was being done commercially in factories and warehouses. So, saw an opportunity to build a brand and a business. The name FloorGuard, I think, was tremendously successful. It's very descriptive of what it does. A lot of people in the industry know that name just because it does roll off the tongue really well. So I think we're just kind of ahead of the curve.
It is a great brand. I love the name. Great. And so that conversation with Nicholas Jan was when? What year are we in at this point? In month, if you recall?
Yes. So we were in 2024. This was probably around May or June, probably around June is when that conversation took place.
So a year ago.
Yep.
So as Nicholas tells the story of this phone call, he hears about the business, the size of the business, and he basically says to you, Jan, I think this is an independent sponsor deal. What about it made it an independent sponsor deal? Why do you think that he said that now looking back, or whatever he said in the moment?
Yeah. I think there was a few things. First and foremost was the size. So, $4 million, there's not really a way to put together SBA, even if you go up to pari passu, the business ultimately sold for $22 million. It was a 5.9x multiple. And, that was the fair valuation for the business. Without doing, moving the SBA aside, the only way to really do that would be to put in, a sizable equity check into it. So the full equity raise ended up being about $7.5 million to put into it. The rest was funded by a combination of, seller note and an SBIC fund, their debt investment into it. But the amount of the equity raise meant going out and actually looking for, sizable equity checks, $100,000, $300,000, $500,000 equity checks going out to different funds. And it disqualified the SBA because it was too big for that. One of the things that Nicholas also talked about in that call was one of the big benefits of going down as an independent sponsor and not going down the SBA is you don't need to do a personal guarantee at that point, which I'd already resigned myself to doing a personal guarantee. And even with that one, I'm still all in. We've invested everything that we have into it. But there is something really freeing to know at the end of the day, it's not, if the business goes under, they're not out for your house and, all the assets that you own. There's not necessarily that same amount of risk, which again, I didn't know that was an option. The I guess, quote unquote, downsides of going down an independent sponsor path would be the deal economics are really different. So in my mind, as a self-funded searcher, I was envisioning 80, 90% ownership, maybe even 100% ownership of the business. I was envisioning, a 10-year payoff for an SBA, loan. Here, looking at, what money I would be putting in and what money I would need to raise, the ownership looked very different. So now instead of being, 90% owner, I'm, 30% owner of this business. And now I have a board of directors. And now, instead of having, just pure equity, there's also a carry that's involved in there. So that mindset shift took a little while for me to get comfortable with. And I had to do a lot of both soul searching on, do I want a board of directors? And is that going to feel, kind of like what I'm looking for? And then do the economics of it still make sense? And so that took probably about a week or two. So still fast, but it took me a while to get comfortable with that change in the economics and just what the day-to-day would be.
Let's double click on that. Jan. This is central. And just I'll pull in one sort of some flavor here. You mentioned the 30%, it's actually carry, not equity. I'm going to ask you to differentiate those two, but effectively your percentage of the proceeds of this adventure is what both of those words mean. It's 30%. It almost feels like a traditional search fund, in at least in terms of economics. So in traditional search funds, if you hit the performance hurdles, searcher will ultimately see 25% carry at the end of it all. And so in your case, it's 30% for this deal. One of the things that has been talked about ad nauseum on this podcast and in Searchland is self-funded versus traditional search funds. And so in one of the big pros of traditional search funds is that there is no PG, which I heard you just say. So in some sense, this feels similar to one deciding between or getting used to doing a traditional search fund instead of a self-funded search. Do you think that's a fair comparison?
I think so. Yeah. And then just to clarify, so the 30%, so the carried interest in this deal was 20%. So it was 20% carried interest, but it was 30% ownership that I ultimately had just based on the equity check that I put in. So that's where the 30% came. But no, you're exactly right. It's very similar to a to search fund kind of economics. And you would still have investors and a board and all of that. So yeah, I would agree. It's a fair comparison.
Great. And then so just say more about carry versus equity that you just glanced off, but explain to people who don't know the difference in those terms and how you can have a different carry in equity.
Yes. So the equity would be just based on the dollars that you put in. So for simple math, let's say, you're putting in $10 million, everyone's putting in $10 million into the deal. And as, the sponsor, you're putting in $1 million, you would get, 10% equity. All the equity is just based on the total amount of dollars that are being put in. The carry is kind of the extra payment for the sponsor for reaching certain deal hurdles. And in this case, it was everything after a 10% preferred return. So after investors got all their funds back and a 10% return on their invested capital, anything above and beyond that would then get split with, in my case, 20% of it going to me as the sponsor, and then 80% of the additional returns going to all the other investors. And so that's what that carried interest would be. And so it's the other kind of added carrot in an independent sponsor deal. The only other one that I didn't mention was the deal fee that was a part of this as well. So for finding the deal and getting it to close, another part of my sponsor economics are having a deal fee that I rolled in fully as equity into the deal. So for in this case, it was $500,000 that was part of the deal fee that gets rolled in as equity. So it increases the amount of ownership that I have in the company.
And if the proceeds to you are based on your carry numbers. So let's say the business sells for $100 million, we hope, and you have 20% carry, you've met the hurdles, and you get 20 million of that. How at that exit moment does the equity, what role does it play if fundamentally your proceeds are dictated by the carry?
It's just another way of getting the proceeds. So, one, I think most investors need to see skin in the game from a sponsor in order to feel comfortable with that. And so that was one, my skin in the game to show, hey, I'm putting in, a very sizable equity check. That for me and my family, that was, $1.5 million, what we put into just as our own equity check. And like I said, that was all of our savings, 401k, we went all in. And I think that did a lot to get my investors comfortable with that, because when I was going and raising capital, one of the questions would be, what are you putting in? Because if it's just, I found the deal and I'm just going to roll my deal fee into that and I'm going to get carry, and there's no personal guarantee, well, you're kind of just playing with other people's money at that point. And for me, it was my first time, running a company, being an independent sponsor. So there was a lot of, I think, right questions about, is Jan going to be successful? I don't have a proven track record to show. So my way of demonstrating confidence is I'm going to put in my own money and, an amount that will hurt a lot to lose. So, and the equity part of it just increases the amount of returns that I'll get. So, we've got 3 different tranches. The equity shareholders get paid out first, and then there's the, Class B shareholders, Class C, which would be the carried interest. And I believe a lot and do believe a lot in this deal. So I really wanted to maximize the economic return on it. So carry was one way to do that, but the other was I wanted to invest as much of my own money into it so that I could benefit from the eventual exit as much as I could.
That point about skin in the game is really important in independent sponsor land. Whenever Minds Capital is looking at a deal, it's one of the key questions asked. What are the sponsors putting into the deal? And this, for those who are not used to independent sponsor terms, this deal fee is basically the credit to you, sponsor, for getting the deal, finding, sourcing, doing the deal, getting it across the finish line. And it's usually a percentage of the enterprise value, usually in the hundreds of thousands of dollars. And almost always LPs want that to be completely rolled into the business. So while plus you bringing personal capital, your own personal balance sheet into the deal. So it's a flag if the sponsor's not bringing their own capital, and it's a flag if they're pocketing a lot of the deal fee. Let's talk a little bit more about the lender economics here and kind of the lender structure. So this is, as we've said, key feature here is that there's no personal guarantee. So we are outside of SBA land. who did you use for your lender, and how did that come together? What did that look like?
Yes, that's a good question. So I used Oxer Capital. They're an SBIC fund. They're out of Columbus, Ohio. So Oxer Capital, and then they needed to bring on another SBIC fund because this deal was a little bit too big for them as well, called Everside Capital. So ultimately, the debt portion that was written was $13.6 million, and that was divided equally between those two SBIC funds. And as I was going through it, I kind of learned what an SBIC fund was. It wasn't a type of lender that I was familiar with. So, an SBIC fund is still backed in some part, and I'm going to get a little bit out of my depth here, but still backed by the SBA in some way. Some of their funds are backed by the SBA. They act primarily as a lender. So while they do, and in this case, both Oxer and Everside did invest equity alongside with their debt, they primarily act as a lender, and they act as a bank. And they have an underwriting team as opposed to a private equity firm, which is writing really just an equity check when they invest into a business. What I loved about this SBIC fund model was, one, they had skin in the game on both sides. They provided the debt and they provided equity. So their vested interest was making sure the company did well, not just necessarily paid back the debt. I got introduced to them by Nicholas, so that was another credit that I need to give him. Oxer, I think, helped. Wrote the debt for one of his first investments, and I've had a great experience with the team over at Oxer and Everside. The other thing is they're a little bit more flexible on the payment terms. So I believe it's a little bit more similar to how a real estate investment deal would be. So it's all interest-only payments for the first 5 years with a balloon payment in year 5 for the principal amount. So it makes it so that you've got a lot more cash flow the first few years to reinvest back into the business. You're not amortizing that debt. And then the expectation would be that at some point you refinance in maybe year 3, 4, or 5 to a more conventional senior bank once the business has grown, and you can delever it somewhat. So it creates the ability to invest in, CapEx, marketing, OpEx, whatever you might need in the beginning, which was really nice. I mean, FloorYard has grown organically, but we've also, just the nature of the way that the debt is structured, we've had plenty of cash flow to reinvest in the business, and we're not feeling the same cash constraints that you would feel if you're trying to amortize 25% of that debt every single year, or 20% of that if it's a 5-year note.
Great. There was a lot there, Jan. Let me underline a few things. So to the last point first about the interest-only payments. So as everyone understands, if you don't have a big loan payment that you have to make and you're just servicing the debt with just the interest, that frees up all that cash flow to invest in your business, as you just said. So gives you a lot more room, which in independent sponsor deals, the expectations by LPs, by your investors, is that they will grow. There's much more of a mandate to grow than in self-funded search land, while investors also want to see self-funded searchers grow their businesses. Here, it's much more explicit and demanding, frankly. So whatever capital, whatever oxygen you have to affect that is a good thing. And let's also just make another contrast here between self-funded style, SBA style search and independent sponsors. On the one hand, I'll tie in your kind of psychological shift here. On the one hand, as a self-funded searcher, owning 80, 90, as you said, maybe 100% of the business feels like the pinnacle of flexibility because you are the sole owner, or almost the sole owner. In some sense, that is true. But the way to do that, 99% of self-funded searchers do that, is by an extraordinary amount of leverage. 80, 90% of the deal is with an SBA loan. And what that does is it burdens the business with heavy monthly loan payments. So in some sense, you have a lot less flexibility going into the business as a self-funded searcher if you've taken on a lot of leverage, because you're servicing this enormous debt. So flexibility on paper, from the perspective of you being an owner and kind of being able to call all the shots you want and not really having to answer to anybody or live under a mandate. but a severe lack of flexibility in terms of your cash flexibility, which ultimately is what business is about, is capital allocation and resource allocation. So interesting kind of nuance there on the point of flexibility. Other point that I wanted to underline here was, so SBICs. These funds, these SBICs, you hear about constantly in independent sponsor land. You hear about them never in search land. Mm-hmm. And as you said, they are kind of SBA associated pools of debt capital, but also many of them also do equity. So they're different than your traditional lender, because traditional lenders, SBA lenders, for example, only care about protecting downside. They really don't care about anything else. Sure, they'd love to see your business succeed, but only to the extent that means that they're likely to get their money back.
Right.
And SBIC has upside. They have some equity as well. They're a bit of a hybrid. They're mostly debt. So in your case, the check from Oxer was 80% debt, 20% equity. But that 20% equity means that there's alignment on both sides. They want to see you. They're really incentivized to see you grow as well, because they benefit directly from that. Does Oxer have a seat on the board?
They do, yes. So they have.
How does that play out?
So Oxer and Everside both have a seat on the board. The way that we have 5 people on our board. They each have one board seat and then an observer seat. And we meet quarterly for the board meetings. We do monthly, financial reviews. But the way that plays out is they'll sit on the board. We'll review our strategic direction, how the company is performing, and then we have myself on the board. My COO is on the board, and then we have another one of our investors who's on the board, who ran a kind of a different coatings company before, was introduced through the same network of Oxer, kind of Nicholas, all of them. And so the 5 of us are on the board, and we've had three board meetings, or 2, going on to our 3rd board meeting. The thing that I think I've really found that was different than what I expected was having a board and having investors. There was a fear that was going to feel like a lot of oversight and dampen creativity. I've felt very different. And I think I've been lucky. I have a great group of investors and a great board. In a lot of ways, I feel like I have a network to tap into and a group of supporters, right? I mean, we're all aligned. We all want FloorGuard to succeed. And whenever I've asked for, connections or introductions, I now have a pool of people who are eager to help out and to lend their networks and their time and their resources. And frankly, their thought partnership too. We have a board who's seen a lot of deals, and they've seen what works well, what doesn't work well. And there's I think a good sense of accountability that I feel as the sponsor and the CEO to make sure, every single month we're making good progress on what we said we were going to do in the last board meeting, our strategic investments. I think I would feel the same way if I owned 100% of the business, but I think there's a bigger edge to it, and a bigger pressure to make sure that you're a good steward of the company, because it's not just your money, it's investors' money, it's banks' money. There's a whole lot more people that are involved there. But I think I have a very supportive group. And it's felt good to be able to tie in and get that expertise. So that was a surprise. I didn't quite know what that would feel. Now, don't get me wrong. I do still feel pressure for us to hit, our forecasts and maintain, this balance of growth and reinvestment and all that. But it's felt much more. I still feel like I have a lot of power and influence to be able to make the decisions, to spend the money, and to kind of make the day-to-day calls. It doesn't feel like an overbearing type of set of governance. And I don't think that's true necessarily of every SBIC fund and every board. I think some are more involved, but I think if you pick your board well and you've got folks who, you trust and you can lean on and you can, feel comfortable being transparent for, I think it can be a really good experience. It's been in my case anyways.
Well, one key purpose that a board serves also is ultimately not maybe as the boss of the CEO, but they can remove the CEO. Mm-hmm. And you are the CEO, which is actually a little bit of a wrinkle to the independent sponsor model, which we'll get to. Maybe you've said all there is to say there, but this is one of the key things that you had to get over that week after you digested your call with Nicholas. Mm-hmm. Having people to answer to. Let's not call them bosses. That's a little too pat, but having a group of people to answer to that you're accountable to versus not the board and your investors. I mean, Minds Capital, us, frankly, you're talking to one of them. Let's hear more about that philosophical evolution. How did you ultimately get comfortable with it? Was it just kind of the bigger, smaller slice of a bigger pie is ultimately worth it, or something else? Or talk us through that, because that is really essential here.
Yeah, I think there's a few flavors. Some of them that I got, as I was doing that couple of weeks of soul searching and pivoting, and a few that I now realize and have internalized. And so just to underscore it, I think the independent sponsor model is really powerful. And I think it's a really interesting path. And I do think that as more people learn about it, there's going to be more maybe hybrid sponsors, kind of like me, because I still consider myself, my DNA is very much still an operator and an owner operator. I just, have used this vehicle to be able to get into, a larger business, but I don't see myself being a deal maker, kind of like other independent sponsors, and make, 5, 6, 7 deals, build a portfolio. I still operate FloorGuard, and I want to continue operating companies moving forward. But you're very right. I mean, in our LLC agreement, in the board agreement, there's clauses where the board can remove me as CEO if I'm not performing well. And that is something that I needed to get comfortable with. The big thing is I fell in love with the company. I fell in love with FloorGuard, and I really saw a lot of potential there. So really a lot of the decisions that I was making were trade-offs because I felt so strongly about running this company and wanting to do that and seeing the potential here. And so to me, the trade-offs on having oversight and having a board and having more reporting requirements felt like a pretty easy trade-off to make to be able to get into the seat as the CEO for FloorGuard in a $4 million EBITDA business. The other thing was, as I was looking through some of the investments that we could make and just running the math on the cash flow that we would have, it actually made me more, I think, sober about the SBA model. Because when you look at how much money the SBA debt sucks up in a business, those first year, it's pretty tight. There's not a lot of room for error, especially if you're levering up to 90%. And what I've experienced now on the flip side is we have plenty of money to be able to make investments. And we, outside of the first 2 to 3 months where we were still building up our cash balances outside of working capital, I don't log into the bank account every day stressing about what's that number and do we have enough to make bank payments and, can we pay payroll? It's a bigger business, which means it's much more stable than a smaller business and allows us to make more strategic decisions and to act faster when we see an opportunity. I'm now able to fund marketing initiatives and to, buy more, more crews and more machinery and open up more locations a lot faster because we just have more cash flow coming in and less of it's being soaked up by the debt. And so frankly, that's all I realized afterward. And as I was running the models, there were two things. One, I fell in love with the company. And then as running the deal economics, I realized my own personal returns and my family's returns, because a lot of my family's also invested in the company as well, are actually higher here because the numbers are bigger with the way that this could play out and the exit opportunities here. The economics, I think, are going to be bigger here than if I had gotten the $750K SDE business. I think just the dollars, even if the percentages are smaller, the dollars themselves are bigger in a a base case or an upside case.
And you'd think that is intrinsic to a larger business, to using an independent sponsor model in a larger business, or is it just intrinsic to FloorGuard and the opportunity for growth that you see here?
A little of both. I mean, certainly I think FloorGuard has more opportunities to grow that I saw. But I do think being in a larger business, I think it's easier to grow a larger business because if you fundamentally have a good product and you see, deficits in sales or marketing or on the distribution end, you can act faster. You're not bootstrapping. I mean, how many people on your podcast will say that they had to reinvest back into the business after they got the SBA, loan? They had to put in another 50 grand or another 100 grand. And I think that's just indicative of when you're taking out that much debt, you don't have a whole lot of room to, supercharge growth. So you might see a couple of opportunities, but you can only go after one of them, versus here, we can really go after 2 or 3 opportunities and still have, cash reserves and be building up, balances for potential acquisitions down the road, bigger ticket things that could come with that.
One minor point we're just getting very far away from, and so I'm getting back into the weeds a little bit of your relationship with your lender, but it's important for people to hear. I think it's the case broadly in a structure like you have with Oxer, where you have, it's a hybrid debt and equity check, and they're on the board. You don't need to be so concerned with covenants. And for SBA buyers, they might not know what that is, but a covenant is with your lender meeting certain performance requirements of the business. So it's more than just you're paying them back according to the amortization schedule. They also want to see that the business is performing in certain ways. And if it's not, even if you're making your loan payment, you violated a covenant, and that can be trouble between you and your lender. And that's covenants don't exist in SBA loans, which, like so much in SBA land, is an exception to the rules of most finance. Covenants generally always exist in conventional loans. In the case of an SBIC, if they're close to the business and they're on the board and they have equity in the business, they might overlook or understand if you violate a covenant here or there, because they understand the business and they're right there kind of alongside you, and they're not going to necessarily hold your feet too close to the fire if it's just a momentary dip or a J-curve dip, and you can explain it away. So just wanted to call that out, because it's an important feature if you start talking about taking, debt that's not SBA debt. Yes. All right. Now circling back up to where we were in the conversation, Jan, also talk to us about as the deal became an independent sponsor deal and all the mechanics that shifted, the sophistication of putting a deal like this together, and maybe just start with the materials that you have to assemble. I mean, your FloorGuard deck is, a 100-page tome, as all sponsor decks are and are expected to be.
No, 100%. So there was a lot of quick work that needed to happen between the making the switch to this is going to be an independent sponsor deal to now, I oversimplify that eureka moment of, oh, this is possible because, Nicholas did that and that was great and introduced me to Oxer. But then there was the other oh crap moment, which is now I got to go raise, another, $5 million. Like, where is that going to come from? Now, Oxer and Everside certainly clipped away at a good chunk of that, but I needed to go talk, I believe, I don't have the full numbers, but call it anywhere from, $2 to $3 million that needed to be raised from outside investors outside of Oxer, Everside, and the money that I was putting in. That was an overwhelming thought in the beginning. That felt like a lot. $2-3 million. Where is that going to come from? And the first step was I need to put together a pitch deck. That this is where I leaned a lot on my kind of consulting background. I know how to make a deck. I did that for a living for many, many years. But it was, dissecting, what's the story of this investment? Why do I believe so strongly in FloorGuard? What makes FloorGuard poised to grow? And then it's also the economics of the deal. So, what's the sale price that we agreed to in the LOI? What's the seller note structure? And then once you put together, an LBO model, what do you expect the returns to be in a downside case, base case, and an upside case? And for, depending on what investors you go to, most of the investors don't want to see an overly optimistic, base case where you're projecting, growth that has never happened before. I think depending on how cynical you are as an investor, I think a base case should be the business continues to do basically what it's been doing over the last, 2 or 3 years. An upside case is a little bit better growth, and a downside case is it actually slows down a little bit. But the whole dance here is making it pencil out so that in each of those cases, you can have an IRR that's, in that 30 to 40% range, at least certainly in a base case and an upside case. And I believe in my downside case, the IRR was 23% or somewhere in that range. And you're right, it's a tome. It's I think it's, hundreds and, it's dozens and dozens of pages. It's a big Excel model. And then it's pitch calls where, you go in front of an investor and you talk to them for 30, 45 minutes and they grill you on all these questions, and they ask you, 15 different reasons why this could all go south. And then you narrow it down to the people that seem to not think you're totally crazy. And then you come back to them for round 2 and round 3. Meanwhile, you've got an LOI that's got a timeline on it because you've signed an LOI. The sellers aren't going to wait forever. So you have to kind of do this in 4 to 6 weeks. And I literally had a note in my phone that just had, here's the equity size that I need, and here's the interested parties that I had, and I just kept scratching them off. Here's another $300,000 check. Here's a $50,000 check. Here's a $1 million check. One of the the funds that put in $1 million, and so doing that over 4 to 6 weeks was a lot of calls. It was particularly stressful and also reinforced I don't necessarily know that I love making deals. I think there was a lot of stress in that whole time period between raising the money and putting in a lot of my own personal cash into due diligence, paying for quality of earnings. And, to quote you, Will, it's a big boy quality of earnings at that point. It can't be a $5,000, $10,000 quality of earnings. It's a big business. It needs a, full, CPAs and accounting firm to go run through everything. Investors want to feel really confident that you vetted it, legal diligence and all that. So as all of this is going, I'm seeing the bills rack up and I'm $75,000 in on diligence fees. And I know that all of this is probably likelier to break apart and not transact than it is to transact at that point, which was very stressful. But at that point, everything is kind of moving fast, and you have a clock where you need to make sure that you can actually transact this deal, and you're going through diligence. But there's an enormous amount of belief that needs to happen, and getting a lot of keeping momentum going, because a deal wants to die. I think that's I feel like I've heard that quote a bunch of different ways. I certainly felt like that, but it was 15 different ways the deal wants to die, and you're just trying to keep it alive as much as you can. Meanwhile, kind of hemorrhaging money left and right as you keep going through that process.
Yeah. On the hemorrhaging money piece, by the way, this is also a feature of independent sponsor deals where why it's so hard for independent sponsors to get started. And we kind of compared this to the traditional search fund economics earlier. This is a big difference with traditional search funds, where the fund that you've raised as traditional searcher goes toward these deal costs, goes towards supporting you. In your case, or in independent sponsor's case, it's all out of pocket. And so that's why it's much easier to be doing your second and third deal as an independent sponsor, because you have some cash flow to work with. But it's just investment off your personal balance sheet, with the threat of that just being chalked up to dead deal costs. The deck, did you build the whole thing yourself?
I did. Yep. So built all of that. That was a very long weekend project with a lot of iterations. But yeah, it kind of came together pretty quickly. And like I said, I was in consulting, so a lot of my training up until then was building decks and pitching to executives, which is not dissimilar from pitching to investors. So it was a lot of that. And so it came together. The LBO model itself, I did get some help from some of my investment banking friends who'd been in that process, where I didn't know the first thing about building an LBO model and how much detail would go into that. So I put together my own crappy Excel model the first time around, and then had my friends help me with that to make sure that it was, what investors would expect to see. So we went through a couple of iterations on that.
When you came to us and we had our first call, we were very impressed with you, Jan, as everyone can hear how bright you are, what a great communicator you are. And often, I think with Minds Capital, when we get people on the phone who are pitching their deals, we are seeing them toward the end of their raise, because we are a gap equity check at Minds Capital. So they've already raised a lot of their money, and now they're looking to fill gaps. So they have had many iterations of these conversations already. So they're practiced at their pitch. And so they always, I'm always quite impressed with how well sponsors answer almost any question you throw at them. But is that just a feature of the fact that we're speaking to them late in their raise? And are those first few conversations much choppier? They must be.
Oh yeah, they're horrible. For me, there were. Anyways, I can't speak for all sponsors, but for me, it was a bloodbath. It was I had to. I knew some benchmarks around what the market would bear in terms of carried interest, and what people would believe in an upside case and a base case. But those first couple of calls, it was defending one, FloorGuard and the investment. A lot of questions around epoxy. That's a commodity. Why do you believe that you can continue to command this kind of gross margin? And why do you think you can grow? The business had grown pretty significantly the last 2 or 3 years, but a lot of that had happened after COVID. And there was a big COVID supply chain crash, which brought a lot of buyers into the United States. So a lot of questions around why do you think you can sustain that? And the first few calls that I did were terrible. They were really bad, but it also helped me figure out what I needed to get tighter on in the story, where I might need to tweak my deal terms a little bit. And it got a lot better towards the back half of it. But it also, frankly, every time I got a question from an investor that I didn't have a great answer to, it helped me develop a thesis around it that in a lot of ways we've kind of implemented as a strategy now that the FloorGuard is up and running. So I think it was valuable, but it was tough the first couple of ones. And I think it gets better once you've done that, and you can also point to a track record. For me, I didn't have a track record. All I could say is, I've been in building products consulting. I've worked with some of the larger, building products, building materials companies out there. But again, you look at a management or a strategy consultant, and everyone's thought is this is a person who just tells other people what to do, makes some slides, doesn't really know how to operate a business. And so I needed to, make people realize, hey, I really wanted to get into the weeds, and I had a good sense of kind of practically how you operate a medium-sized business, and it took some convincing.
And while it was grueling to have all those investor calls, there is the benefit. Of course, the stakes are high, but there is the kind of side benefit of you're essentially workshopping your thesis and against dozens of people who are just sitting there poking holes in everything that you're asserting. So it really does help you to in your own mind, I'm sure, get that much more confident in the direction you should take things.
Yeah, I think so. And frankly, if you can get through that process and you can get enough people to invest in the deal, it's another form of due diligence. You're doing the QOV, you're doing the legal diligence, but you're getting other people to believe you.
Exactly. Jan, I heard you say that this deal part was not your favorite part of this. And so let's now turn our attention to how you are a little bit atypical as an independent sponsor. First of all, many people who kind of identify as independent sponsors are former private equity. There's, if listeners think that there's a preponderance of former finance people in search, try independent sponsor land, where everybody is a former private equity person or banker. Not everybody, but like you, but many of them are. And so they really identify as deal makers. And the kind of typical independent sponsor might look like somebody who has 3 or 4 or 5 businesses in their portfolio. They are not active as the CEOs in those businesses. They're on the boards of all of those businesses, and they're providing strategic direction and kind of moving chess pieces around, as the saying goes. But they're not operating, certainly. That's really the traditional format. Less traditional is doing one deal and being the operator. So in some sense, you might argue that you did independent sponsor economics, but you are, a CEO more than an independent sponsor. Anything to respond to that?
No, I think that's exactly right. I think at the onset, what made me want to buy a business was to operate that business and to be the day-to-day operator, be the day-to-day CEO. And so even as I was moving over and getting into larger deal, and as I think about my career moving forward, I don't envision myself going and just making deals and rolling up a whole bunch of businesses and then installing CEOs and continuing to do that. That doesn't appeal to me. I like the messiness. I like the being on the ground floor, working with the team, building up management teams. I like that. And I that's what I'm doing at FloorGuard for both of the business units that we have. And I'm having a ball doing it.
Yeah. Yeah. Well, it's just great for people to, as the curiosity in independent sponsorship grows, and as the world of independent sponsorship grows, and searchers will either do what you did and want to skip ahead and become sponsors, or as their next thing, they'll be independent sponsors. It's important to remember what you just said, because it's easy to look at typical independent sponsors and think, okay, I have to be a deal maker. What I have to do is do 3 and 4 deals and then just kind of be cycling through deals as I buy businesses and exit them. But this other Jan style is, no, you can take the independent sponsor deal structuring and economics and go be the CEO of a single business. So you can still bring that, bring the structure of independent sponsor land to a single deal. We've spent not a lot of time on the business itself. And before I let you go, I want to hear about this. This was something that you came to our LP meeting and shared with the Minds Capital LPs, which we really appreciate. So tell us what the business model is as you buy FloorGuard, and now how you're trying to evolve it.
Yeah. So this is one of the big opportunities that I saw in looking into the deal, and that is the way that these building materials are bought normally is you as a contractor might be doing a garage or a factory or whatever project you might be doing. So you're going to go buy the materials for that job. Normally you're going to go into a local epoxy supply shop or your Sherwin-Williams or Home Depot to go do that. The way that the business was selling primarily up until that point was direct e-commerce. So the, 15 million or so that we were doing in revenue, all of that was coming in through our e-commerce site being shipped out of Chicago. And so what you would have is contractors that would be buying, a pallet at a time, 2 pallets at a time, half a pallet. So really the market that we were serving was this pretty successful contractor that could afford to carry that much inventory and could plan in advance for, I know I want this color of flake in my floor, or I want to inventory that and I want to sell, I want to have this much chemical. The reality is most of the market's nowhere near that. The market is, I go buy what I need locally that day, that next day, and we didn't have a whole lot of local presence. So what we're doing intentionally is now building out our distribution channel and having local distributors who either carry the FloorGuard name but are still independent distributors. So FloorGuard Products of Houston is an example. That's a store that carries our name but is owned by an independent owner. Same thing for FloorGuard Products of San Antonio. And so you can go in there and you can buy 3 gallons of epoxy as opposed to having to, buy, a pallet of that epoxy from us. And the reason that you couldn't buy in small quantities was because it's expensive to ship. All of this stuff is hazmat. And when you buy, a 3-gallon kit that might cost $200, it might cost $200 for us to ship it to you. So it just makes it just completely cost prohibitive. But the challenge in doing that is when you introduce a distribution model, you now have to have enough margin for the distributors to make their money. So they're now independent business owners. We have to introduce enough margin for them to be able to make 20 to 30% on their resale. So the balancing act that we're making is, we know that there's a much bigger addressable market if we have local distribution, but when we open a distributor, we can't sell behind their back. So we can't sell direct in their territories, which means we now need to give those local customers over to them. Well, immediately that's a kind of a cannibalization of revenue because you're now selling to that distributor for less than what you would sell direct to a customer to. They resell to them. And what we're seeing right now is volume has ticked up, like I said, 20, 30%. We've seen that volume uptick. Revenue is up. So our revenues are up 5 to 10%. And the first 2 quarters, our profitability was up, which to me was fantastic. I was excited that we were able to kind of keep that balance of making room for margin while increasing our volume and still having profitability. But we're starting to enter our J curve now, where we're starting to see profitability kind of plateau for a little while until we catch up with now our distributors get their own customers. And it's a really powerful business because the average annual value for a contractor is anywhere from $75,000 to $150,000 worth of product purchases a year. And that's just somebody who's doing 2 or 3 projects a week. So not a crazy amount of volume. And so it doesn't take a lot to create really healthy local distribution businesses. You could have 20 customers and you'd have a $1.5 million business with customers that are that valuable. But it takes some time where initially we kind of have to take a step back or sideways in order to make room for that. And we have to be very diligent about not seeing as selling against our resellers, because there's many in our industry who have gone down that path, and then they've turned their back on their resellers and started to sell direct, and then they've lost their whole distribution channel. So we're in the middle of that dance right now. We're trying to navigate it as best we can because we don't want to take a big step backwards in terms of net income, but it's playing out. We're seeing a big uptick with all the new stores, and they've done their restock orders. They're continuing to buy more product to continue to restock, and it makes it so that we go from having thousands of customers who call us for technical support to now having a smaller segment of distributors who we can support and now own those ultimate kind of customer decisions. And I think that that's a model where FloorGuard can 10x, 20x the amount of revenue that we do if we continue to go down that model, versus selling direct, we would cap out. And I don't know where we would have capped out, but it's a much smaller market of contractors who can buy direct from directly from a manufacturer.
And that 15 million of revenue was 15 million of revenue from chemical?
From chemical, that's right. Yep.
So essentially you're shifting that, this dance is shifting that $15 million in chemical revenue that was being sold directly via website orders to these bigger contractors that do a lot of epoxy business. You're shifting all of that into the distribution channel, which will mean dollar for dollar, they're less profit. But once you've shifted it into these distribution channels, those distribution channels will unlock much, much greater penetration and allow these much smaller contractors, which is probably an additional 80% of the market, to buy in smaller quantities. It's very powerful.
Well, and it doesn't take a lot to believe that would be the case, especially as we dug more into the data. So we look at some of the states where we're selling into, and where we sell direct, we might have 3 or 4 customers. And that's it for the whole state of, and I'm making it up, but let's say Minnesota as an example, because we don't have a local distributor there. 4 contractors. It doesn't take much to believe that you could get to 20 in the whole state of Minnesota, because there's hundreds of epoxy contractors in every single. When you look at our competition, the epoxy depots of the world and the Cimarrons of the world, they're opening up stores left and right because it's the same model. I mean, construction doesn't matter if it's epoxy or if it's just remodeling. The contractor goes and buys the material that they need for that day or the day before, and they don't have a whole lot of money to be able to float a whole bunch of inventory. So it doesn't take a lot to believe that, and we need to enable our distributors by giving them our initial kind of customers as an investment into their business, but it's a flywheel that when it starts turning, they start to see all the sales that come through, they start to spend their marketing dollars, and it's a better model, in my opinion, than having company-owned stores, which a lot of our competitors are doing, because that comes with a ton of overhead. The amount of having to put somebody in there and actually staff it, the lease, all that sort of stuff. Here, if we can get a distributor to, and a lot of these are just exclusive FloorGuard distributors, they don't carry anybody else's product. They can, we basically multiply our marketing dollars, we multiply our sales force without having to spend all that money, because we now have their marketing dollars, their sales team. There's a network effect that comes in here that is beginning to play out. And I think, if we have a conversation in a year, I hope to say, we've seen a lot of the, the fruits of that, and that we're now, 30, 40, 50% bigger than we were before.
Yeah. Well, it also takes less time because you can just kind of turn on a new distributor by shipping them product, as opposed to standing up a whole store and remodeling 100%. And finding the location and the lease and the person to man the store. Very exciting, Jan. And what of the actual coating business, the installation business, that the kind of your legacy business that was 5% of revenue, is that something you're still nurturing?
It is. And that one's a very interesting story in that it takes up a disproportionate amount of my personal time. And it makes a lot of sense when you think about them. They're really just 2 separate businesses. But one is call it a 300 SDE business, and the other is a 3 million EBITDA business. And expect an owner operator to do in a 300 SDE business is exactly what I'm doing, like going out on estimates and helping to build that out and, growing. We've grown that part of the business. I think the last month, that business was only made money 2 months out of the year when I took over. All the other times it was subsidized by the products business. Now it consistently makes $40,000, $50,000 worth of net income every month. And we're consistently doing, $250,000 worth of top line revenue. And it's actually growing faster than our products business. Granted, the numbers are smaller, but it's cool in that it's very useful for us because we use it as our R&D department. It helps us have more authentically talk to our contractor customers to say we run an installation business. We give them leads from our business. But what I didn't factor in was running a 300K, 400K SDE business is a lot of time and a lot of personal time to go do that, which is, I think I didn't anticipate that this would feel like running two separate businesses, which is a big leap from never having run one business to now essentially day one running two separate businesses. Now, it's really probably 1.75 because there's a lot of people that, there's a lot of resources that we go from one spot to another. But it's doing really well. And I get excited by it because it gets me in front of customers and contractors and out in the field, and I enjoy doing that. But I'm excited for when it gets a bit bigger for us to be able to put in, maybe a proper general manager to go run that business unit and for it to continue to expand.
Well, and to think that many SBA self-funded searchers would buy such a business, that would be their primary business, the $400,000 installation project-based business. And what are you doing differently there that has turned it around to being profitable and self-sufficient and indeed growing?
That one, a lot of that's marketing. So in this industry, it's not quite where HVAC is and where a lot of private equity has swooped in and they've already turned on the marketing, the website, lead generation, follow through. This is still very much the wild, wild west. So I think what's exciting about epoxy is that you have a lot of flooring installers who have shops, but they don't have a Google My Business profile. They don't have a website, or if they do have a website, you put a lead in there, you'll probably never get a call back because the owner is out there actually installing epoxy floors. So this is one of those industries where if you have a website, you have a call service that answers the leads within a few minutes of them coming in, your appointment setting rate, your job success rate, win rate can be north of 70%, and that's what we're experiencing. So this industry still has a lot of you can win a lot of projects just by doing the
answering the phone
essentials, answer the phone, get back to people. And a lot of what we do on the product side is help our contractors understand that, because the best way for us to grow our business is if our contractors can grow their businesses. So we've actually partnered with a marketing firm that they rebuilt our website. They're actually now rebuilding the websites for a lot of our contractors, and we're investing some of our own funds to help do that because we've seen it's not rocket science to be able to have a multi-million-dollar installation business in this industry. And if any of your viewers are listening in and might want to buy a business in this space, there's a lot of opportunity here. And I do think in the next 5 to 10 years, I think there's going to be more private equity roll-ups here. We've seen 1 or 2 relatively large roll-ups happen, but I think there's going to be a lot more in the next, in the next 5 to 6 years. And there's a lot of tailwinds. More and more people are installing epoxy floors in their garages and basements and outdoor patios. So that's just my guess. I think there's going to be a lot more PE activity here.
Well, I had said there have been a couple of guests on Acquiring Minds. I think maybe just one, Mike Okaravi, who bought a towing business and an epoxy installation business at the same time. But I saw him subsequent to his interview, and he was really unhappy with his epoxy business. It was just, now it was a very small business, and so it probably just came from with all of the headaches of, I think it was a 400,000 revenue business.
Sure.
But interesting to hear that at a certain size, that there's a real business to be had there, and that it's kind of, where plumbing and HVAC was in terms of digital marketing 10 years ago. That opportunity is still to be had. That's actually a really great tip. So thank you for that, Jan. We got to start wrapping up here, Jan. Let's return now to going from searcher to independent sponsor and how that informs the future. So, as you touched on when talking about your due diligence, your financial diligence, building your deck, you are showing returns to us, your investors, and usually those returns manifest themselves in terms of an exit. There's some sort of liquidity event. What did you tell your investors about the future and where this goes?
Yeah. So there has to be a liquidity event. For investors to put their money in an independent sponsor deal, there needs to be some way, particularly for funds, to be able to pull their money out. And so there's a few structural ways that can happen. One is every single one of the investors has, a put option, which means at the end of year 5 of the investment, every investor has the right to get bought out of their shares, and that would, an independent evaluator would come in and say the company is worth X amount, and at that point, the investors can say I'd like to get bought out, and then we start a negotiation around what that looks like, whether the company does that from its own cash flows or balance sheet, or there's some sort of note. But there is, everyone can, legally pull out their money. Realistically, I think what is likeliest to happen is there's going to be some either private equity firm or strategic buyer, be it, a larger distributor or, somebody else who wants to acquire FloorGuard. And that would be the exit that we would plan for in, years 4 through 5 and start planning around that. And for me, I think what that would mean is probably stick around for a transition. If things are going well, I would imagine a strategic buyer or private equity would want me to continue running the company for several years thereafter. But it does give me, optionality to take some chips off the table, and I can see my career going, kind of back into a similar model where it might become kind of serial acquiring, where, hey, I've done this, hopefully proven a track record. FloorGuard's been successful. People, trust that, if I'm putting my name behind a deal that, I believe in it, and, could see myself raising, more equity to go run another business that could kind of be in that same realm. But I think early on in my career, I thought I could map out exactly what everything would be. When I was first in consulting, I thought, oh yeah, I'm going to map out my 20-year path, and I'm going to be a partner by this date, and then it's going to be lovely. Or when I went into, startups or into tech, I was going to do this and grow as a product manager. So I've stopped trying to guess at what I will do in the future. I just want to keep doing what I like to do. And I know right now I love operating. I see a lot of growth potential for FloorGuard. I don't think I'll ever go back to corporate. That's not in the cards for me. I want to stay in the small, medium business world, but I could see that either, doing kind of what I'm doing with FloorGuard again and kind of raising another fund. I could see, potentially, joining a kind of a large, FloorGuard becomes part of a larger organization at some point for the next acquirer, kind of running that for a little bit. And then, maybe going in, becoming more of an investor for a little while and taking a little bit of a break. So I don't know. But I can tell you that I don't want to continue just doing a ton of deals and step away from FloorGuard and have another CEO run that. The only way I could ever see that happening is if we buy maybe one more company where I would install, maybe a general manager for FloorGuard, and maybe we buy a coatings company that's in an adjacent space, pipes or furniture or something like that, and maybe I go and operate that company because it's a little fresher and needs more integration. But I really want to keep doing what I'm doing and really grow this as large as it can, because I think there's a ton of growth potential for FloorGuard, and I think it'll be, hopefully as much of a rocket ship as we can make it over the next 4 or 5 years.
And about that timeline, Jan, so that is just to double underline it, that's a key implied difference between the sponsor and searcher model, where often searchers want to hold indefinitely. What if you wanted to hold the business for longer? What if you wanted to hold the business for 10 years indefinitely? What if so much of the value that you're creating here, building out a distribution network and enabling contractors to become better at their own businesses, to create all that pull-through demand for you. There's a tailwind here. You think that there's a lot of opportunity in epoxy, in actually epoxy installers, that industry is actually underserved. It's going to take more than 4 or 5 years for all of that to truly come to fruition. What if you wanted to do it for 10 years? Or what if you wanted to be active for 10 years and then hold it for the next 20? Does the sponsor model prohibit that? Or is there a way to do that? And just how do you think about long-termism versus the typical private equity model, which is what independent sponsor is, of sell at 5 years?
It's a good question. I think that for me, I still feel like there's optionality where at the end of the hold period, there's ways where if I still wanted to be involved with FloorGuard, I can, and still get my investors a liquidity event. There could be, private equity infusion that creates a recap, or, there could be, a strategic buyer where I can still stick around as the CEO and still run that as a division. I think knowing what I know about myself, I like to do things and give, my whole heart into something, but I also like to experience different businesses. And I can see myself doing this for 4 or 5 years and, having a great time with it, but then wanting to try, to grow and build something different in either a different industry or a related industry. I see myself as a builder. And I think once FloorGuard gets to a spot where it's big enough, where it's interesting to a bigger private equity or a strategic buyer, I think I will start to dwindle some of my interest just naturally, where I think I'll want to go build something a little bit smaller again.
Yeah. Well, that also is part of the appeal probably for you of the independent sponsor model, that it's sort of baked into it are 5, 6, 7 year chapters. And if you don't think you want to do something forever and ever and ever, then that's baked into the model. And you can kind of expect that after 5 and 7 years, you'll be able to shift your focus a little bit onto something else.
I think so. Yeah. Frankly, I can't imagine doing anything for the rest of my life. That seems like a long time to commit to doing kind of one thing. It does feel like there's optionality. And I think at some point having the option to take some chips off the table and to reinvest and to do that in a number of different places feels like you can definitely still do that with the independent sponsor model and still stay involved or not. Like, I think a lot of the same options are on the table. I don't see it being that big of a difference, because I think for me, I don't know that I would do an indefinite hold of any company. I think that for me, that's just not where my innate interest is. Anything more to say about the independent sponsor now that you're on the other side of it? You're an operator, you have investors, you're in it now, that you haven't already said. Do you reflect back and on your hesitation or having to get comfortable about the model any differently now that you're in it? No. So I feel very grateful for how I ended up in this position, and for getting, for Nicholas telling me about all the, how the independent sponsor model worked, for meeting Oxer, for getting introduced to all my investors, getting to meet you. I feel very grateful for being here, and I wouldn't do anything differently. I think that it is a really powerful way, even just the independent sponsor economics of getting involved in a larger business. And about once a week, somebody will call me and they'll ask, about my experience. And I always tell them, I think the biggest advice is, knowing what I know now, I would always buy bigger and get into bigger companies. I think that and I'm not talking about, $10 million companies, but $2 million to $3 to $4 million, I think, is a really nice range, because it's big enough. Of EBITDA. Yep. Because at that point, you're such an independent sponsor now. You speak in EBITDA. I know. That's what sponsors do. Okay, go ahead. Because you've got the ability to invest into growth initiatives that a lot faster than you would. I think one of the big stressors that I didn't fully emotionally prepare for is, day one, you have your bank account, you've got whatever working capital you put in there, and then 30 days later you've got your first bank payment that you need to make. That 2 weeks from then you have your first payroll to make. That cash flow cycle is, I think, emotionally was way harder to deal with than I expected going into that, and I didn't lever as much as I would have with the SBA. So for me personally, I think there's a lot of power in going bigger and being able to share some of the economics with other people and investors, and to get in the game maybe a little bit earlier than you would if you were trying to be 100% owner of something and be able to participate. So that's the advice that I give. I don't know that it's right for everybody, but I think there's a lot of power in that and not over levering. And yes, and just to be clear, in independent sponsor land, deals are typically leveraged. The leverage is 2 to 3x, so call it 40 to 60%, as opposed to 80 to 90% in SBA lands, just to give everybody some context. So again, an exception here, and how SBA is such an exception in the world of finance that you would leverage something 90% is pretty unheard of. What would you say to people who find, your message here pretty compelling about this necessary sophistication to do this? Because I am hesitant to oversell independent sponsor. Everybody should go be an independent sponsor and take down a $4 million EBITDA business, because it's a much more sophisticated undertaking. Everything from the deck to the size of business and the LPs, the investors that you'll convince. Everything in between. So whereas I feel like self-funded search, most hardworking, smart professionals can figure it out. I'm not so
glib about advocating an independent sponsor approach to just everybody to just go do.
I would agree with that. I think there's the SBA, to me, and the opportunities that it affords is a great example of the American dream. I mean, it's really just a uniquely American thing. We've got this opportunity. If you find the right business, you can get all of this, government-backed money to be able to go into a business, and you don't need to get a whole bunch of investors. Normally, if you do need some investors, it's friends and family, and you don't need a 100-page tome to convince them. It's really just they're betting on you. There's a lot of work that's involved in getting investors to sign, that amount of money away. I mean, I think for anybody who's considering that path, I think it's reflecting on it. Can you convince somebody to write a $300,000 check, a $500,000 check, a $1 million check? And that takes a lot of analysis. That takes a lot of, I think, polish and coming across as confident and kind of selling what that future would be, being comfortable being grilled, and then being, good on the spot answering questions, because a lot of your trial run in those pitch decks meetings are, what you're going to be like as a CEO. So I don't know that you need to necessarily be from a private equity background or investment banking background. I mean, I wasn't. Strategy consulting has some, there's definitely, experience with, investment cases and presenting to executives, but I would agree. Well, I think it's a path that's out there, but I don't think it's as accessible to everybody, because there's just thresholds that you have to cross and convincing that you have to do, where the SBA path is just much more democratized right now.
Yeah. And I would just say to anybody who hears us say this and feels discouraged, one, if you don't have a banking background, don't have a finance, private equity background, one good way to become an independent sponsor eventually is to go do a self-funded SBA search, be successful in that, and then 7 years later, come back around to being an independent sponsor. And you will have what so many finance people lack, which is operational experience. And that will really differentiate you, and is quite a powerful thing to be able to sell to investors. So there is a path here, everybody, even if you don't come from finance. Anything else, Jan? What a wonderful conversation. Anything that we didn't hit on that you wanted to?
No, I don't think so. We covered a lot.
We sure did. Thank you for staying over. Thank you for being such a great communicator and sharing, everything from the psychology to the travails of your sellers to what you're doing with the business. Just a wonderful trajectory, and so much to learn from this interview. So I really thank you for it. We at Minds Capital are just honored to be in your deal and part of the FloorGuard journey. So it's really exciting. And as I said, personally, really exciting for me to have somebody that we've invested in on the pod for the first time. So thank you there as well, Jan.
Awesome. Thank you so much.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode with an introduction to the interview, a link to the video version on YouTube, and soon, key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.